Commodities. Who doesn't enjoy a cafe latte with some avocado toast with a side of lithium-ion batteries to power the overabundance of devices? Honestly, it's nice to see the Rodney Dangerfield of asset classes finally getting some respect. Today's ETF Battles features a head-to-head contest between commodity-focused ETFs from Blackrock and Invesco. So which ETF is the better play for commodities? Find out right after this. Welcome to ETF Battles. I'm Ron DeLegge, and this is where we congregate to analyze ETFs versus each other with the purpose of uncovering the best investment opportunities for you. Now, in case you didn't receive the memo, audience participation is encouraged, and if there's a certain ETF battle that you'd like to see, well, then send me your ETF ticker symbols in the comment section below or on our Twitter feed at ETF Guide. We can do double, triple, and quadruple headers, so make it interesting. Now, also be sure to visit the description section below for research links to our judges, and you can also check out the link to our program sponsor, Direction. Today's ETF contest was sent to us by DeLegge, and it's a duel between an actively managed commodities ETF from Invesco going up against an index-linked commodities ETF from Blackrock. Now, I'm not sure either of these ETFs is necessarily the best choice for commodities-focused ETF investors. Boy, I sure hope we get some wild cards on today's show. But with inflation being stubbornly high, it's lifted interest in hedging and investing with commodities. And thank you, DeLegge, for your thoughtful and timely ETF battle suggestion. Be sure to hit the comment section below for your choice of an ETF Battles coffee mug or a shirt. Now, judging today's contest is a combo extraordinaire. We've got Tom Psarofagis with Bloomberg and John Davi at Astoria Portfolio Advisors. Tom analyzes ETFs with a team of Bloomberg analysts who are the absolute best in the business. Be sure to join them for their upcoming June 14th webinar. It's going to be at 11 a.m. Eastern Standard. The registration link is posted below. And John manages the inflation-sensitive ETF. That's ticker symbol PPI. Guys, welcome to the show. Great to see you.
Yeah, glad to be back.
Glad to be back as well.
So our four battle categories are cost, exposure strategy, performance, and mystery. And mystery is where our judges can choose a single factor or maybe multiple factors that they feel is crucial and pertinent to today's contest. Our judges can also nominate wildcard ETFs if they feel there's a better choice elsewhere. They can also opt for split decisions. Now, I'll be keeping score. At the end of the show, we'll declare an overall winner. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. So let's kick things off with the first category, which is cost. Tom, please get started.
Sure. Yeah, it's, I thought it'd be closer given that they're both sort of similar commodity future products. But the Invesco one, PDBC, is 64 basis points, and the iShares COMT is 48. So that's 16 basis points. That's a pretty noticeable difference. Even if you look at the spreads, which I like to factor in total cost, trading spreads are about the same on both. So it's definitely more expensive to buy PDBC. It is also active, so keep that in mind. But I think 16 basis points is a big enough spread to give it to the other one, to iShares COMT. It's definitely a cheaper product, and even when you factor in spreads.
Thank you, Tom. That's a strong start. John, you're up next. How do you see it when it comes to cost?
I agree with a lot of what Tom said. The only caveat is that, I think you can charge more if you're going to deliver outperformance. And as we'll talk about later, PDBC has outperformed, on a 1, 3, 5 years. So I think you're getting, returns per unit of management fees. So, so I agree with everything Tom said in terms of, which one's more cheap or expensive and trading costs. But, you're paying more for PDBC, but you're actually getting the outperformance.
So which is your vote for?
My vote is for COMT, which is cheaper than PDBC.
All right. That takes us next to exposure strategy. And this is where it really gets interesting, where we dissect the differences in the investment approach of these funds. So you're still up, John. Give us your take.
Yeah, I think, we have to understand that, commodities, they have futures, right? So, if you're going to buy like an oil future, what are you going to pay, when you have to roll that contract? So I do think you need to be active. I do think you need like a very skilled kind of manager to kind of look at all the roll dynamics and what point you want to be in the futures curve to roll. So I like PDBC. I think it's had better performance. I think it's no K1. I think that's a big deal as well. We're active managers here at Astoria Advisors. We like to use, kind of rules-based passive ETFs. We're open to actively manage ETFs as well. But, commodities inflation is such a highly nuanced area that, I think you really want to go with somebody that has demonstrated skill. And I think the PDBC has demonstrated, significant skill. So that's my category winner.
Thank you, John. You're up next, Tom. How do you see it when it comes to exposure strategy?
Yeah, he brought up a lot of really good points, and especially when it comes to commodities, let's say, forget about trying to get exposure to physical companies. In terms of like these types of ETFs, you're going to own futures. Like roll cost is just part of the reality of trying to own one of these products. They're both really broad-based. They're like 14 or so commodities in both of these ETFs. I like the ability that the power shares, now it's just Invesco, that they could be active.
Boy, you're really dating yourself, Tom. Power shares.
Yeah, I know. I probably do that at least once a day. I like that they have the ability to be active and find sort of opportunities within the curve. But COMT tracks the S&P GSCI index, which this is production weighted. So both are going to be pretty heavy in energy. It's just going to tilt that way. But what I noticed about PDBC is that it actually has a little bit more gold exposure now, which has helped. And I think that's what's led to some of the outperformance. So they're both really decent default choices for commodity futures ETFs. I would give, to a lot of the same points that John was saying, the advantage to PDBC because it is active. It could sort of maybe take some overweight and underweights of different commodities. So I like that ability, and it's been around a long time. I think they're one of the better products in this space. So I will give the exposure strategy to PDBC.
That takes us next to performance. And Tom, you're still up. So break it down for us. Which of these ETFs stands out when it comes to performance?
Year to date, they're pretty close, but as you start to space it out, PDBC definitely starts to run away with it. And I think the gold allocations definitely helped it. And for a longer term product, I'd say if these were the two choices, I would like PDBC. Again, keep in mind a lot of investors might tend to run this up against like a commodities oil index or whatever that might not be futures. Just keep in mind, it might track well in the short term, but there is that futures roll cost you need to be aware of that's built into it. But overall performance, for two ETFs that you think might be closer, it was pretty surprising to see PDBC run away with it as much as it had. So on the performance flag, I'll give it also to PDBC.
Thank you very much, Tom. And I'm surprised we haven't seen any wild cards yet, but there's still time for our judges to pull that out of their rabbit hats. We'll see if they do that. John, you're up. In terms of performance, give us your analysis, please.
So we run an inflation strategy, PPI. It's a multi-asset. It uses commodity ETFs, physical commodity ETFs that use the futures, Then we have natural resource stocks and et cetera, et cetera. We actually have used things like GCC, the WisdomTree Actively Managed Commodities ETF. We've used COMT, which is just like the Bloomberg, commodity index, which is more like a third oil and energy, a third precious metals, and a third agricultural. I said before, you want an active manager, highly skilled. I think that the issue that we would have with PDBC, which is why we never used it in our PPI ETF, is that it is, heavier on energy and oil, per what Tom said before. The reason why we've used, let's say, COMB is that it's just, we think that you should split your risk out across the commodity complex, where it's more like a third precious metals, a third agricultural, and a third oil. Oil is very risky, right? It can go up and down a lot. A couple years ago, oil futures were negative. Then, a couple years later, it went to 140, I think, last July or 2 Julys ago. So, you just have to be prepared for the volatility. I don't think you should ever time, commodities, inflation-linked strategies. But so I'm giving you two wild cards. Ron, one is GCC, which is actively managed, and it's got, more along the lines of where we think you should be on the commodity spectrum. And and then COMB just for like the pure cheap passive, which is like significantly cheaper than the COMT and the PDBC. So I'm going to give my category winner to COMB and to GCC.
Thank you very much for that. Now we shift to the mystery battle category. This is where our judges can pick a single factor or multiple factors to make their argument. So, John, what is your mystery battle category, and which of these ETFs wins it?
Again, for me, I always want to put my money where my mouth is, or put my money where my mouth is, or whatever the saying is. But basically, we've used these two other ETFs which are not in the battle. So I'd give the category winner to them again, GCC and COMB. I mean, PDBC, it's taken in quite a bit of assets on a relative basis compared to the COMT. I mean, assets are about $5 billion in PDBC, COMT is only about 800 million. And I find that a little startling given it's, kind of iShares is such a behemoth in the space. So if I'm going to pick, the one of the two, it's probably PDBC because of what I explained earlier. But, we have used GCC and COMB in the PPI ETF, so I'll give that as the kind of overall category winner.
Tom, you're up next. What is your mystery battle category, and which of these two ETFs wins it?
Yeah, I was actually going to use this time to bring up a wild card, but now there's a lot of wild cards getting thrown in here. But I thought I like GCC a lot too. I think that's a really great pick, and so is CMB. It's really cheap. I think it might be the cheapest in the space. There's an interesting one that I really like, and it's from Direction. It's COM is the ticker, and it's this Direction Broad Commodity Strategy ETF. And what I like is it can go in between commodities and cash. It's trend following. So let's say if someone was holding it, it could allocate the cash. If it doesn't like commodities, it can come back in, or it can only like certain commodities. So if you look at some of the other commodity ETFs this year, they're all down. COM is up like 5% this year. And that's because of its allocation of gold and silver. So I get that it might not always work all the time, but it's a really interesting product that I've always liked from Direction. That it has this ability to have a safety net too, that it can move to cash. So I wanted to throw in even another wild card. I really like COM US. I know the tickers are now getting that they're COMB, but it's COM just straight. That's the ticker. I like this one. So I actually want that to be my pick for, in that mystery battle, which is a wild card. Now I'm sort of jumbling up the different categories, but I like this one from Direction quite a bit.
Excellent. Well, let's give our judges one final chance to give us their overall battle winner. And Tom, you're up, so give it to us.
Sure. Let's say from the first two choices, PDBC is usually the popular default choice for commodity. That's why it's got $5 billion in assets. It's used a lot by models. I also think a lot of investors will be benched to something similar to like the GSCI index, so they use something like that. So I get why there's a lot of practical uses for it. But if I had to pick one, I would actually pick the wild card one that I had brought in, which is COM. I like that ability that it can be flexible. It's got that safety net, and it can move in and out of commodities or out of it if it's not, not opportune times. So my overall pick would be the Direction Broad Commodity Strategy ETF.
Thank you, Tom. John, your final chance to weigh in with your overall battle winner. Give it to us.
I'll go back to what Tom just said because I think, he did a good job. If I'm picking between those two, PDBC because it's, more the behemoth. It's got a proven track record. It has had some outperformance. So I would pick that over the COMT. As far as like what we've used at Astoria, I think in general, like it's good to split between active and passive. COMB, pure passive. Third to third to third. You know what you're going to get. It's the Bloomberg Commodity Index. It's very cheap, like Tom said. And then, having like the skilled active management in like WisdomTree GCC, which is going to allocate across the different, kind of commodity complexes. They also added like, Bitcoin as an allocation, which I thought was good. And it's interesting. And it's helped it this year, given what Bitcoin has done year to date. So putting my money where my mouth is, GCC and COMB would be my overall category winners just because I've used it. But if I'm picking between those two, the ones that are in the show, I'm gonna lean on PDBC.
Well, you don't need to just pick PDBC because you gave us some great wild cards, and I'm gonna have to make a final choice. A lot of ticker symbols have been thrown around on today's episode, so man, me the umpire, this is a high pressure situation. I have to deduce what our wonderful judges just said. And according to my battle scorecard, this is going to be a triple split decision between wildcard ETFs GCC, COMB, and COM. And man, I didn't expect it to turn out like this, but that's the way I think it went down. And our judges raised some awesome points. Commodities are one of those asset classes, as we started the show with, that's been, I think, underappreciated, sort of the Rodney Dangerfield of asset classes, but it has been changing. Commodities are getting more respect. And John liked the balance of active and index approach. He liked COMB for its very simplistic indexing approach, but then he liked GCC for its active approach. And Tom surprising us with his wildcard pick, COM, which is a trend-following commodities strategy, and it's been actually performing quite well this year. And he likes it because of that dynamic, active approach of being able to flexibly choose between cash and commodities, and that has certainly lifted performance. So put these particular ETFs on your list. If you're looking at investing in commodities, I think these are all very noteworthy choices that merit your attention. And judges, great job for breaking down today's commodities ETF showdown. We couldn't have done it without you. Keep up the good work.
Yeah, this is great. Thanks for having me.
Thanks for having me.
Be sure to visit the description section below. We've got research links to our judges. And while you're there, check out the link to our program sponsor, Direction. Which ETF battle would you like to see in our next episode? Give me your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you next time.